we are covering these 8 top actively traded stocks that are bullish today. While watching price actions, let us inform you our review on PGR. Progressive Corporation is one of the big names in insurance, covering everything from personal auto policies to commercial liability coverage. Whether it's insuring everyday drivers or small businesses, Progressive has built a strong reputation with its competitive pricing and digital tools like Name Your Price and Snapshot. Lately, investors have been paying attention to its growth potential, and Wall Street is starting to take notice. Zacks recently highlighted Progressive as a solid growth stock, giving it a B growth score, and a Zacks rank number 2, a buy. Well, earnings are expected to jump 9.2% this year, easily outpacing the industry average of 3.6%. Cash flow growth is another major plus, with a staggering 115.9% year-over-year increase, far ahead of its peers. On top of that, analysts have been revising earnings estimates upward, which is typically a strong sign that the stock could keep climbing. But it's not just about growth. Progressive is also rewarding shareholders. The company just announced a 10 cents per share dividend, giving it a yield of 1.8%. While its dividend history has seen some ups and downs, the overall trend has been strong, with an average growth rate of 22% over the past decade. With earnings per share projected to grow 12.9% next year and a manageable payout ratio of around 33%, Progressive seems to be in a solid position to keep those payments coming. Investors seem to like what they're hearing, as the stock is up 1.53% today. Between strong earnings, rising cash flow, and a steady dividend, Progressive is shaping up to be a strong choice for both growth and income-focused investors. Our review on VTR. Ventas Incorporated is a powerhouse in healthcare real estate, owning a diverse mix of properties that cater to an aging population and the growing healthcare sector. With over 1,300 properties across North America and the UK, the company is deeply invested in senior living communities, outpatient medical buildings, research centers, and specialized healthcare facilities. This broad portfolio gives Ventas a unique position in a market that's only expected to expand as demographic trends drive demand for quality senior housing and medical services. The stock is up 1.16% today, and that bump likely reflects investor confidence in the long-term stability of Ventas' business model. The need for senior housing is climbing as baby boomers age, and Ventas' mix of properties allows it to benefit from both private pay senior living and medical tenants, which tend to provide steady, recession-resistant cash flow. Additionally, the company's focus on operational insights and data-driven decision-making helps it maximize efficiency and profitability. With healthcare and senior housing demand only going up, Ventas is positioned well for the future. If it continues optimizing its portfolio and capitalizing on market trends, this REIT could keep delivering strong returns for investors. Our review on DUK. Duke Energy Corporation is one of the big players in the utility sector, keeping the lights on and the gas flowing for millions across the Southeast and Midwest. Through its electric and gas utility businesses, Duke delivers power to homes and businesses while managing a diverse portfolio of energy infrastructure. As a regulated utility, it's known for its steady cash flow and reliable dividends, qualities that typically make it a favorite among income-focused investors. Now, the stock is up 1.5% today, but there's been some buzz about whether it's overvalued. A recent valuation using the dividend discount model suggests Duke's fair value sits around $92.21 per share, which is quite a bit lower than its current price of $117. That's a 27% premium, meaning investors might be paying a little extra for the company's stability and predictable income. But, to be fair, models like this have their limitations. They rely on assumptions about dividend growth and discount rates, and even small tweaks can shift the numbers significantly. That said, Duke does have some challenges. Its earnings growth has lagged behind the broader electric utility sector, and its debt levels remain high, with interest payments that aren't fully covered by cash flow. That could be a concern in a rising rate environment. On the flip side, the company is still expected to see earnings growth over the next few years, and its P/E ratio suggests it's in a reasonable range compared to peers. So, is Duke Energy overpriced? It really depends on how you look at it. If you're an income investor, you're probably in it for the dividends and long-term stability rather than short-term price movements. But if you're looking for value, this stock might not be the best bargain right now. Either way, Duke's solid market position and future earnings growth could keep it in the game for long-term investors who don't mind paying a premium for consistency. Our review on AZN. AstraZeneca PLC, a science-driven biopharma giant, continues to make waves in oncology, rare diseases, and biopharmaceuticals. Known for blockbuster drugs like Tagrisso, Imfinzi, and Lynparza, the company has been expanding its footprint in cancer treatment, and today's FDA approval for Imfinzi in muscle-invasive bladder cancer, MIBC, is another big win. The stock is up 1.3% today, and for good reason. This approval is based on strong Phase 3 Niagara trial results, showing a 32% reduction in cancer recurrence and a 25% decrease in mortality risk compared to standard chemotherapy alone. That's a significant clinical edge, giving patients a more effective treatment option and boosting AstraZeneca's positioning in the competitive oncology market. Regulatory filings are also in motion outside the US, with approvals being sought in the EU, Japan, and other key markets. If those come through, the addressable market for Imfinzi in this indication could expand significantly. This is a solid growth driver for AstraZeneca's oncology segment, reinforcing its leadership in immunotherapy and targeted cancer treatments. For investors, today's market reaction signals confidence in AstraZeneca's ability to keep delivering on innovation and regulatory wins. The near-term focus will be on how quickly the company can push for additional approvals globally and drive uptake in the US. With its expanding pipeline and continued success in oncology, AstraZeneca remains a key player to watch in the biopharma space. Our review on COLD. Americold Realty Trust Incorporated, the powerhouse behind temperature-controlled warehouses, had a solid day, ticking up 1.11%. Now, that might not seem like a huge jump, but for a company that thrives on stability and long-term contracts, it's exactly the kind of movement investors like to see. Americold isn't about flashy gains, it's about being a critical part of the global supply chain, ensuring food, medicine, and other temperature-sensitive products move efficiently from point A to point B. So, what's driving the confidence? The demand for cold storage has been steadily rising, thanks to factors like growing e-commerce grocery sales, increased frozen food consumption, and a more complex global supply chain. Americold's vast network, spanning North America, Europe, Asia-Pacific, and South America, positions it as a key player in this space. Their ability to acquire and develop more warehouses while maintaining strong occupancy rates is a major plus. And let's not forget those joint ventures in Brazil and Dubai, which give them a foothold in rapidly growing markets. Investors who follow Americold know this is a long-haul play. The company benefits from steady demand, strong customer relationships, and a business model that generates reliable cash flow. While today's 1.11% rise isn't earth-shattering, it's a reminder that Americold is a rock-solid name in the logistics space. As the need for cold storage only increases, this is the kind of stock that keeps delivering over time. Our review on EXE. EXE Energy Corporation, a key player in the U.S. natural gas market, is making waves after a strong vote of confidence from Wall Street. Morgan Stanley just bumped up its price target from $137 to $154, reinforcing its overweight rating, while Zacks upgraded the stock to a strong buy. Investors seem to like the momentum, pushing the stock up 1.19% today. So, what's fueling the optimism? It all comes down to earnings potential. EXE Energy is seeing a sharp increase in earnings estimates, with projections for 2025 jumping 55.5% over the past 3 months. That's the kind of growth that gets analysts and institutional investors excited. When earnings expectations rise, stock prices tend to follow, and that's exactly what's happening here. The company's stronghold in key natural gas basins like Haynesville, Marcellus, and Utica puts it in a prime position to capitalize on rising demand, especially as LNG exports ramp up. With strategic operations close to major export infrastructure, EXE Energy has a clear path to long-term growth. Its vertical integration from drilling to production also gives it an edge in managing costs and maintaining efficiency. For investors, the combination of bullish analyst sentiment, rising earnings expectations, and a well-positioned business model makes EXE Energy a stock to watch. If these forecasts hold, there could be more upside ahead. Our review on NextEra Energy Incorporated, a big player in the electric power and clean energy game, saw its stock climb by 0.6% today. This is a company that really knows how to blend traditional energy infrastructure with a strong push into the future with renewable energy. Through its subsidiaries like Florida Power and Light and NextEra Energy Resources, it's been steadily expanding its footprint in clean energy, particularly solar, wind, and battery storage. On the utility side, it owns over 35,000 megawatts of generating capacity and has an impressive network of transmission lines and substations across Florida. But what sets it apart is how it's positioning itself for the future. NextEra's investments in clean energy, including solar projects and renewable fuel initiatives, align with the growing demand for sustainable solutions. This gives investors a mix of stability from its regulated utility business and the exciting growth prospects of clean energy. That 0.6% uptick reflects the market's positive sentiment about NextEra's ability to capitalize on this shift toward green energy. While it might seem like a modest move today, it's a sign that investors are confident in the company's strategy to not just meet current energy needs, but also lead the charge in a cleaner, more sustainable energy future. So, as clean energy continues to gain traction, NextEra is well positioned for long-term growth, and today's slight bump is just a small glimpse of that potential. Our review on GILD. Gilead Sciences Incorporated, a leader in biopharmaceuticals with a focus on critical diseases like HIV, cancer, and viral hepatitis, saw a solid uptick of 5% in its stock recently. This rise comes despite some investor activism around shareholder proposals, including suggestions to separate the chairman and CEO roles and to develop a more comprehensive human rights policy. These proposals, which Gilead is advising against, will be discussed at the company's upcoming annual meeting. Still, investors seem to be focusing on the positive momentum from Gilead's strong Q4 earnings report and its strategic partnerships, like the one with LEO Pharma. The company's stock has surged 18% over the last quarter, a clear reflection of its solid financial performance and the impact of new therapies, particularly in areas like HIV and oncology. Gilead's ability to drive long-term growth, achieving an impressive total shareholder return of 110% over the last 3 years, highlights the strength of its product portfolio, which includes key treatments like Biktarvy and Trodelvy. Its expansion into oncology, particularly with therapies like Yescarta, positions it as a major player in the biopharmaceutical space. Even though Gilead is facing some shareholder challenges, the company's resilience and continued success in launching and managing high-demand therapies have kept investor sentiment high. So, while today's 0.57% increase might seem modest, it's clear that Gilead's long-term outlook continues to be strong, driven by its innovative portfolio and strategic partnerships. Please subscribe, give the video a like, and watch more from our playlist. Thanks.